Do you want to learn about stock market, investing, and want to enhance your knowledge in the field of finance? Then become a part of this channel. Subscribe to the channel, hit the bell icon to get the most out of this channel. Now let's start the knowledge ride. Namaste everybody. In today's video, we will understand what is a share, what is the share market, and how the share market works. We all know that businesses need money to survive, expand, and grow. Companies who follow the normal route use profits to support their expansion. But there are other companies which want to take help from the outside. The company needs the funds to grow and expand, and there are different ways to raise money, such as raising money from angel investors or venture capital, or taking a loan from a bank or an institution, or raising money from the stock market, which means raising money from the public. In totality, there are two methods for raising money. The first is debt financing and the second is equity financing. Let's understand what debt financing is. In simple words, debt means loan. A company can raise money through debt from various institutions. They can utilize the money raised, and after a mutually agreed upon period, they have to return the principal amount with the interest. The best example of debt financing is bank loans. When a company takes loan from the bank, the company has to return that money with interest. When company raises money through equity financing such as angel investors, venture capital, stock market, the company neither has to return the money nor it has to pay the interest on that money. So if company is not paying principal, not paying interest, then what exactly is the company going to give to the investors? In return for the money raised through equity financing, the company gives investors a stake in their company, which means the investors get to own a small portion of the company. Now this process where the company raises funds from the stock market, it is known as equity financing. So for investors, the stock market is a platform where any person, rich or poor, can buy shares and become a shareholder in the company. And for companies, the stock market is a platform where companies can raise money from the public. So all the companies listed on stock market exchanges have raised money from the public and in return have given stake in the company to the public. Therefore, these companies are called public companies. When a company raises funds for the first time from the public, it is called as Initial Public Offering or IPO. In the IPO, the company raises money from the public and in return gives stake to the public. In an IPO, there is a direct transaction between the company and the investors. For example, the IRCTC IPO came in September 2019. IRCTC raised 654 crores from the public through this IPO. And in return, the company gave 12.6% stake to the public. You get a stake in the company based on the proportion of shares bought by you. In the IPO, the company along with the investment bank decides the share price, or you can say the price band. The IPO is open for 3 to 10 days. Usually it is open for 3 days, and in these 3 days the investor has to subscribe to the shares of the company and then the shares are allotted. In an IPO, you can only buy shares from the company but you cannot sell them. To sell the shares, you have to wait for the stock to be listed on the stock exchange. After allotment of the shares in the IPO, the stock of that company gets listed on the stock exchange within a few days. And after the company is listed on the stock exchange, you can sell the shares bought in the IPO on the stock exchange. Investors who want to buy shares will buy those shares from you and become a shareholder of that company. When you sell shares, the stake of the company gets transferred to the investor who buys the shares from you. In this way, the shares listed on the company's IPO are exchanged between people on the stock exchange. The transactions on the stock exchange are between investors and the company has no role to play. In an IPO, you buy shares directly from the company, and in stock exchange, you buy shares from other investors. For example, the IPO of IRCTC, which came in September 2019, was opened from 30th September to 3rd October, that is 4 days. Now the investors had to subscribe to the shares of IRCTC in these 4 days. IRCTC IPO was allotted on 10th October 2019 and on 14th October the stock of IRCTC got listed on the stock exchange. Now after 14th October, investors could sell the shares bought in the IPO on the stock exchange. This whole procedure is performed online and you can buy or sell shares anywhere, even on your Goa trip. The stock exchange follows the automatic transaction system, which means when an order of buyer and seller matches, the order gets completed automatically. You need a Demat account with a stockbroker in order to buy and sell shares and invest in the stock market. A Demat account is compulsory and stock brokerage firms work as mediators through which you can buy and sell shares. And in return, you have to pay some charges to the stockbrokers. A Demat account is just like a saving bank account. In the saving bank account, we keep our money, and in Demat account, we keep our shares. There is one more type of account of shares which is called as a trading account. So the shares are bought and sold through a trading account, and the purchased shares are kept in the Demat account. So we can say that Demat account is used for storage of the purchased shares. Demat account and trading account need not be opened separately. Usually both Demat account and trading account are opened simultaneously. Some basic documents required to open a Demat account are PAN card, Aadhaar card, address proof. After opening the Demat account, you can buy and sell shares in 3 ways. First, through the mobile app of the stock brokerage firm or stock exchange. Second, through the stockbroker's website or software. Third, directly by calling the stockbroker. You can talk to your broker and instruct him about the share you want to sell or buy. In some brokerage firms, you do not need to maintain any minimum balance in the trading account. So you can start your investment with a very small amount by opening a trading account with a broker. Guys, you should open your Demat account with a brokerage firm where you get good services at low charges. We have tied up with Upstox to help students start their investment journey. Upstox is a Ratan Tata funded startup and is one of the highest rated applications in India. If you don't have a Demat account, click on the link given in the description below and sign up. After signing up, our team will assist you in getting your account opened. The stock market opens at 9:15 a.m. and closes at 3:30 p.m. All the selling and buying takes place within this time period. Stock market operates 5 days per week, Monday through Friday. Now let's talk about stock exchanges of India. India has 2 major stock exchanges: National Stock Exchange, that is NSE, and Bombay Stock Exchange, that is BSE. There are more than 1600 plus companies listed on NSE and over 5500 plus companies listed on BSE. Monitoring the performance of all the companies is not possible, and that is why indices were created such as Nifty and Sensex. Sensex is the main index of Bombay Stock Exchange, and the term Sensex is formed by combining sensitivity and index. The Sensex is made up of 30 well-established companies from different sectors, and the movement of Sensex depends upon the movement of the stocks of these 30 companies. Nifty is the main index of NSE. Nifty is formed by combining 2 words, national and 50. 50 denotes the top 50 well-established companies listed on NSE. So the movement of Nifty depends on the movement of these 50 companies included in Nifty. Most companies in the Nifty and Sensex are selected from the sectors like pharma, IT, energy, telecom, and financial services. In this way, different sectors are covered in Nifty and Sensex, and that is why the performance of Nifty and Sensex is considered to be the performance of the stock market. You can check the situation of the stock market by looking at the performance of the Sensex and Nifty. When the Sensex and Nifty rise, we can say that the stock market is going well, but when Sensex and Nifty fall, we say that the stock market is not performing well. Now let's talk about your favorite part, investments. Investment is made by the people to earn returns. So, how do they get returns in stock market? Stock market investment provides return in 2 ways. First is capital appreciation and second is dividend. When a company shares a part of its profits with investors, it is called as dividend. However, providing dividends to shareholders is not compulsory for companies. The decision of providing dividend to the shareholders entirely depends on the board of directors of the company. Investors should not depend on the dividend income only. Usually, small and growth stage companies do not give dividends. They prefer to invest their profits in the growth of the company itself. Now let's talk about the capital appreciation. Capital appreciation means the increase in your investment value as the share price increases. Suppose you bought a share of XYZ company 3 years ago for rupees 1000, and now after 3 years the value of that share is rupees 1500. So this increment of rupees 500 in your investment is called as capital appreciation. The capital appreciation is the main source of earning in the stock market. In the long run, the company's share price increases with the growth of the company. So when the company is performing well, the company's market value also increases, which means that the price of the shares will also increase. When the company's performance is not great, its market value starts falling and the share price also declines. So you should always focus on how to make profit from capital appreciation. For that, you have to do a lot of analysis, and we'll discuss about this in our upcoming videos. So that's all for this video. Thank you so much for watching this video. If you like this video, then smash the like button and share it with all your friends and families and relatives. If you have any suggestions or video ideas, do let us know in the comment section, and subscribe to the channel if you have not yet subscribed. We will be coming up with more interesting and detailed videos in the future. Thank you so much. Bye bye.